Good afternoon, everybody. Welcome back to my channel. Yes, it is me, Kadero Hudson, the Wingman. I am here to help you guys on your journey, in your investing journey. And yes, you guys know that I deliver that delicious sauce. So what we have here today, I got some hot sauce for people who love to put hot sauce on their chicken, and I got my salsa because I love tacos. But what we here today, we're going to talk about dividend growth investing and why dividend growth investing is a timeless strategy. Uh, when you think about investing, you have many different avenues. You have growth investing, you have dividend growth investing, and just when you think about just making money right now, besides today, because today is Friday, September 22nd, these last 2 days, because of the Fed chairman Powell, uh, he stated that basically for right now he's not going to raise interest rates, so the interest rates are going to remain the same for right now, but it may be hawkish in the future, and so that caused the total stock market to go on a lower downtrend of the last 2 days, where basically the S&P 500, the Nasdaq, and then the Dow has lost, I want to say, over 3%, which is major. How major is that in my dividend growth portfolio, I was at roughly 50,000, and when my portfolio took its first hit, it went from $50,000 to about 48,500. Now I lost another 1,500, and now I'm at like $47,000, which is quite discouraging. But why I still put money into the market every 2 weeks, whether it's through my 401k or through my brokerage account, we're going to talk about why. So why dividend growth is a timeless strategy. So what you're going to think about is dividend aristocrats. So companies that consistently grow their dividend are popular with investors like me, investors like you, hopefully, that's watching, because these high quality companies typically offer stable earnings, strong histories of profit and growth. So I'm going to go over the reasons why, and then I'm also going to go over a couple stocks for you guys to write down that are dividend aristocrats that have grown as dividend for over 25 plus years or 15 plus years, so that you can do your own research, and hopefully if you like it, you'll add it to either your 401k or your own dividend growth portfolio. So the hallmark staples of consistent dividend growth is stable earnings and a strong balance sheet, which indicates uh, good company health, a well-managed company with a commitment to returning profits to shareholders. Think of Apple, think of McDonald's, Microsoft, etc. And then also commonly seen as durable business models, long-term competitive advantages. Companies that you see every day that you probably even think of, that you get gas at ExxonMobil, Chevron, that you're going to get food from, like McDonald's, uh, Texas Roadhouse. These typical companies that we go and enjoy on a day-to-day basis, that we hardly even think about, but they increase their profits on a daily basis. They increase market share not only in the U.S. but also globally. And so these are the different companies that you think about, that you invest with. Think of Warren Buffett. You invest into a spirit of influence of companies that you know of. Don't invest in companies that you don't know what it does or how it makes money, or that you're not familiar with. So enduring quality. So quality comes, as deserves a place in our investment portfolios, and there's qualitative and quantitative. So qualitative companies that have a durable and sustainable competitive advantage, economic moat, and then quantitative is companies quality that can be quantified by measuring their balance sheets and earnings. So basically, qualitative companies that have a economic moat, like Microsoft, Apple, that has been pushing the stock market forward for the past, let's say, 10 plus years, has have been having returns of over 30%, besides last year, because last year pretty much every stock was down, and the whole stock market was down last year in 2022. So don't hold me against last year, because last year everything was down. So let's talk about this. So the dividend aristocrats have produced higher returns on equities. So as you see right here, for the S&P 500, the S&P 500 have produced high returns of 25.2%. And then right here, the S&P 500 dividend aristocrats have produced 27.7. Now, as you see, that's a difference of 2.5%. But when you compound it on an annualized basis, 10 years, 15 years, 25 years, that 2% difference makes a big difference in your money. So you had $10,000 or $100,000. That difference in the long run will help in regards to reaching your goals a lot quicker than, as you see right here, just the S&P 500. And then more resilient earnings growth, as you see right here. So that's why a lot of people like investing into dividend aristocrats. Most importantly, a lot of times individuals say invest into the S&P 500, but then a lot of times why a lot of people invest into the dividend aristocrats is because solid companies, solid earning growths, increase in dividends, has a track record of increasing their dividends. They come off as a refuge for you to park your money into stable companies that has been around for 50 plus years, that has been also growing its dividends, and you pretty much know about them. So you know that they're not just some random company that just came out of nowhere and you just put your money into it and you fear that it's going to lose your money, or that the company is just going to go out of business, right? McDonald's has been in business for many years. Pepsi, Coca-Cola has been in business for many years. And so a lot of these brands are just high brand recognition, not only in the United States, but when you're in the UK, I could buy a Pepsi or a Coke. When I'm in the Netherlands, in Amsterdam, Ireland, Spain, when I went to Colombia in April, I still was able to get a Coke. I still was able to, no matter the language barrier or me translating English to Spanish and speaking Espanol, I was still able to get a Coke or a Pepsi or some Fritos or hot Cheetos. So it translates into globally, right? And so right here it says, since inception, the S&P 500 Dividend Aristocrats Index has outperformed the S&P 500 with lower levels of volatility. Volatility is key. Volatility is basically the beta. So the higher, more volatile something is, it's like, think of high volatility is like Bitcoin. Bitcoin it's the king of cryptos, but it's high. It's very volatile compared to stocks, but compared to Bitcoin, compared to, let's say, Quant, the crypto Quant, or probably Polygon, or any like lower scale crypto. Bitcoin will be a lot less volatile than that, but Bitcoin compared to the Nasdaq, or compared to Pepsi or Coke, Bitcoin is very volatile. So yes, when you invest into something that's very volatile, it will help you. High risk, high reward. But in times like this, when there's a bear market, bad news, your investment will tank sharply. But when it's a bull run, or there's good news, guess what? Your investment is going to increase and it's going to skyrocket. So, as an investor, you have to think of just in the long run. What is your investing horizon? How much time do you have to invest into something? And as you see right here, consistent dividend growth strategies have outperformed the S&P 500 with less volatility. Right? See here. So the S&P 500 Dividend Aristocrats is in blue. The S&P 500 just index is in orange or yellow, as you see. And as you see, you always got to zoom out. And so within 1 or 2 years, yes, your investment may be negative or it may only increase by a little bit. But if you stay consistent, you apply it into the long run, 5 years, 10 years, as you see right here, boom, your investment will make money, it will grow, and it will compound. And so right here, focus on dividend growth versus high yields. Right here. So what's the takeaway? The takeaway is basically you can invest into the S&P 500. You can invest into growth stocks, but dividend growth stocks, most importantly, the Dividend Aristocrats has helped many investors like myself to compound our money, to grow our investment from $10,000 to $25,000 to right now. My investment's at $47,000, and I'm going to continue to compound my money to invest and so to grow my money to $100,000 and more, so that I can eventually live off of it and not have to just buy certain shares of a particular ETF or index fund and have to sell my whole investment, where I can grow a particular stock to maturity and then live off the dividend. That's the goal. It takes time. Dividend growth investing takes time, but it's not impossible. You just have to stay consistent. So right here, we're going to I use Simply Safe Dividends, and in this section gives you ideas of stocks that are of high 4+% yields, high growth stocks, dividend aristocrats, dividend achievers. And so I wanted to go over just some ideas for you guys of dividend aristocrats. So I went over why the dividend growth strategy with investing in dividend aristocrats was a timely strategy, because of the high returns, less volatility, and then also just the surefire way of just being able to make money in the long run. But let's go over just some dividend aristocrats. So you have ADP, Cintas. I bought Cintas today. You have Archer Daniel, Midland, Brown and Brown, McDonald's, PepsiCo, Lind, or NEE, which is a utility. You have Atmos Energy, Cincinnati Financial, Abbott Laboratories, Caterpillar, W.W. Granger. I'm familiar with that. A.O. Smith, Illinois Toolworks, ITW, Chevron, SP Global, ExxonMobil, Hormel, and then lastly, if that list doesn't tickle your fancy, I wanted to go real quickly and not hold you guys of some dividend achievers that you guys may like and make to invest to, that has been growing their dividend 10 plus years. So you have Visa, you have Discover Financial, DFS, Accenture, Williams Sonoma, Hershey, United Healthcare, UNH, the healthcare giant. We have Costco. We have the semiconductor stock Analog Devices, ADI. Write that down. That's a key stock that's a sleeper that a lot of people sleep on, that you invest in that, it compounds your wealth in the long run. Trust me. You have Broadcom, KLA. We have Kroger. If you go to the grocery store, Kroger is very familiar. Tractor Supply, TSCO, Nike, Microsoft, McDonald's, PepsiCo, that's Moody's, Home Depot. And then lastly, give you another company so you guys write down and do research. You have NOC, Northrop Grumman, which is it's a military defense company. And then Air Products and Chemicals. So overall, the reason why the dividend growth is a timely strategy, because it takes time to build, time to grow, but it's solid, less volatile. You're able to compound your wealth, and when you think of it as a golden goose laying golden eggs. You don't have to slander or kill the golden goose to get the golden eggs, which is your dividends. You continue to buy certain amount of stocks that's going to have a history of growing its dividend, has a history of increasing in their cash flows, and having profit, because of consumers like us that's going to buy Apple products, that's going to buy a Big Mac at McDonald's, that's going to continuously buy enterprise products from Microsoft. And then, as we know that these different companies are going to make profit quarter on quarter, year on year, guess what? As dividend investors, or as investors or owners of particular stocks, we know that basically our ownership of those particular companies is going to grow. And then also the dividend that it pays us, whether it's through actual dividend payments or share buybacks, is going to increase our ownership of the said company. And guess what? By owning assets, we're able to increase our net worth. And so basically, investing into stocks like Nvidia, Amazon, Google, which is good because it increases the share price and it increases your ownership of the company because the price goes up. But at times like right now, during a recession, during a down market, guess what? Even though it sucks that my portfolio was at $50,000 and now it's at 47,000. My portfolio lost $3,000, and I'm pretty sad about that. But my portfolio is still going to pay me roughly $1,600 this year, and it's going to increase because guess what? Starbucks just increased its dividend by 7.5%. Microsoft just increased its dividend for this year by 10%. So the dividend that my portfolio pays me, that doesn't go down or that doesn't go away. It's still, the companies are still going to pay that dividend. And as a dividend growth investor, of your dividend increasing, reinvesting dividend, buying more shares, it's a bit beneficial, and I love it. And so that's why, hopefully, to show you guys this and show you that you get high returns, you're able to sleep better at night at times like this when the market goes down. It's a win-win. So hopefully you guys enjoy this video, why dividend growth investing is a timeless strategy, why it makes money, and why it only makes sense to become a dividend growth investor. So you appreciate this content. Hopefully you rock with me. Like and subscribe to my channel and become a member to my channel and to learn. Let's get this money. Let's view more portfolio updates. And that's it. Peace.